Ever get that feeling like you're the only one who's not in the loop? Like everyone else is riding this wave of excitement, some big opportunity, and you're kind of stuck wondering what you're missing. I think that's what a lot of folks were experiencing back in late 2024 with the whole Indian stock market boom, and then, of course, the correction that followed. We touched on it a bit before, but honestly, the more I dig into these sources, the more it feels like that classic FOMO, that fear of missing out, was a huge driving force behind what happened.
Oh, absolutely. FOMO is a powerful motivator, especially when everyone seems to be making money. And remember, this was during the pandemic. Lockdowns were still a recent memory. A lot of people had a bit more time and maybe some extra cash on hand. It's a recipe for impulsive decisions. And the stock market became really, really tempting for a lot of folks who had never really considered it before.
Right. It's like no commutes, limited options for going out, and suddenly you're seeing all these stories online of people making a killing in the market. So our goal today is to really dive deep into what went down back then. Why did so many new investors jump in? What actually happened? And what are the big takeaways, the lessons learned?
All really important questions. Understanding the forces at play during that time can be incredibly valuable for navigating future market trends and making more informed financial choices.
Oh.
Whether you were part of that whole thing or just watching from the sidelines, there's something to learn here.
Let's start by looking at some individual stories. Real people, real experiences. They really give you a feel for the atmosphere at the time. Take Kanish K, for instance. His story's pretty relatable, actually. He was at home, locked down, scrolling through social media, and just constantly seeing people talking about their stock market wins. He even admitted straight up that he didn't want to miss out. And his research was basically just reading online forums and social media threads, not exactly digging deep into company financials.
Right, and that's kind of a common theme during these periods of market euphoria. Traditional financial advice gets pushed aside, and people turn to online communities, maybe even just their friends, for guidance. And that can be risky because it's tough to separate solid information from speculation or just plain bad advice, especially when you're new to all this.
And yet, at first, Kanish actually made money. He started with mutual funds, dipped his toes in the water, then moved into trading individual stocks, gains. It makes you think, hey, maybe this stock market thing really is easy. Then we have Saloni Puj from Kolkata and Ishan Shah from Ahmedabad. Similar experiences, but with some really interesting twists in their approaches. Ishan, from what I gathered, was pretty much playing it by ear.
Yeah, you could say that. The sources describe him going with his vibes and following investment tips he got through WhatsApp forwards. I mean, it's wild, right? But he actually saw profits, at least in the beginning. It just goes to show how much the market was surging back then. Almost anything seemed to go up.
Right, like that saying, a rising tide lifts all boats, even leaky ones. But Saloni's story is a bit different. She had a feeling, a suspicion, that the market might be a bubble. She knew deep down that those crazy gains probably wouldn't last forever, but she still jumped in. It makes you realize how hard it is to resist that temptation, even when you know there's a risk.
It's that inner battle between logic and emotion. You might know rationally that things are getting overheated, but then that fear of missing out, that FOMO, it can be so strong that it overrides your better judgment.
And then September 2024 hits, boom, market correction. Those quick profits everyone was bragging about, gone, vanished just as fast as they appeared. It must have been a shock, especially for those who were new to the game and seeing their initial wins disappear. That FOMO probably turned into some serious regret pretty quickly.
Yeah, that's a classic pattern with these speculative bubbles. Prices shoot up, driven more by hype and the hope of even bigger gains than by any real economic fundamentals. Then reality sets in, the bubble bursts, and the folks who got in late, often the ones with the least experience, they're usually the ones who get hit the hardest.
So let's break down what actually caused that initial surge in retail investing. I mean, it wasn't just FOMO out of thin air, right? The sources pointed to several key factors. Lockdowns obviously played a role. More free time, more time to tinker with new things, including trading stocks. And then there's the money angle.
Exactly. You had this unusual situation. People were spending less on things like travel and entertainment, and on top of that, the Indian government launched that massive economic stimulus package, 20 lakh crore. So it's not surprising that a lot of individuals found themselves with extra cash and they needed somewhere to put it.
And you can't ignore the tech factor. Online trading platforms made it super easy for anyone with a smartphone to get into the market. It's basically like ordering food online.
Hmm.
That easy access definitely brought in a lot of newbies who might have been intimidated by the stock market before.
While it's great that more people can access financial markets, it also highlights the need for financial literacy for investor education. When it's that easy to buy stocks, there's a real danger that people might jump in without fully understanding the risks.
And that brings us to something called the Margin Trading Facility, or MTF. Can you explain how that worked and how it might have magnified both the wins and the losses during this period?
Sure. Basically, MTF is like borrowing money from your broker to buy more stocks. It's called leverage. When the market is going up, using leverage can really boost your profits. But here's a catch. When the market goes down, your losses are also bigger. And if your investments drop too much, you might get a margin call, meaning you have to put up more money, or your broker might sell your stocks to cover the losses, often at a really bad price. For a lot of new investors who were drawn to MTF by the promise of bigger gains, the market correction probably meant amplified losses and maybe even those dreaded margin calls.
It's a good reminder that understanding how financial products actually work is crucial. High potential returns always come with high risks, especially when you're using borrowed money. Now, we also got some insights from someone with a lot of experience in the financial world, Sagun Agrawal. What was his take on this whole influx of new investors and all the activity in the market?
Sagun offered a more seasoned perspective. He saw the increased participation and the liquidity it brought as potentially good for the market in the short term. More buyers can definitely drive prices up. But his main concern was that a lot of these new investors were lacking a basic understanding of how markets really work and the risks involved. They were chasing quick profits without really considering the potential for losses.
It seems like that sums it up pretty well. Yeah, this perfect storm, extra time, maybe some extra money, easy access to trading platforms, everyone
Yeah.
talking about the booming market, and a lot of new players who weren't quite ready for the risks. And then the correction hit, a harsh dose of the market's tough love, as one of the sources put it.
Yeah, that's a lesson the market has a way of teaching over and over again. It's not about getting rich quick. Real success in investing usually takes patience, understanding how things work, and a well-thought-out strategy. Just chasing trends or following the hype on social media is not going to get you very far in the long run.
Totally. I mean, think about it. If making easy money in the stock market were actually easy, everyone would be doing it right. It seems obvious, but when you're caught up in the excitement and the possibility of quick wins, it's easy to forget that basic truth.
Absolutely. The temptation for fast, effortless returns is powerful. But building real wealth in the stock market takes a different approach, one that involves continuous learning, careful risk management, and a long-term perspective.
So, as we wrap up our deep dive into that wild ride in the Indian stock market back in late 2024, the main takeaways are pretty clear. This huge wave of new investors, mostly driven by FOMO, the initial gains they saw because of all those unique pandemic-related factors, and then that correction that, let's be honest, was probably inevitable. But most importantly, this whole experience taught some valuable lessons about responsible investing and the real risks involved.
Exactly. It's a great reminder that while the stock market can be an amazing tool for building wealth, you've got to approach it with a clear understanding of the potential downsides, you've got to be informed, and you've got to think long term.
And it really makes you think, doesn't it? Thinking about that whole boom and bust cycle, what's really driving our decisions about money, it's not just about charts and numbers. What makes us jump into the market or maybe get out at the worst possible time? And how can we, each of us, develop a more disciplined, more informed approach to building our financial future? Lots to think about for sure.
A lot to think about.